conversation. Crossmarks Victoria Fernandez, George Carvis of MUFG. Victoria, this administration wants to issue more debt. What's the price of that debt going to be?
Jonathan, I think you know what we're going to see if there's more debt issued. We're going to continue to have this supply-demand issue when it comes to our debt. We noticed it in the auctions that we had last week. We had very poor 3-year auctions, 10-year auctions, and we saw rates move higher because of that. There's also this contingency in Congress on the Republican side. We can't even get a Speaker of the House because there is so much controversy going on in regards to spending, some of that having to do with Ukraine. So bringing this bill in where it's not just support for Israel, but linking it with Ukraine, the thought of having more debt brought in is going to really cause yields, I think, to move higher. Once we hit that 5% threshold on yields, we're probably going to see some pain in the equity market. And Jonathan, it's not just those nominal yields, right? Real yields are at 2.5%. When we get to this level, that's typically where we end up having some kind of a policy mistake. You have a lot of cash flow into the short end of the curve. The Fed starts rethinking what they're doing. I think there could be a lot of volatility around this decision.
George, your take on that. Is this Fed going to be comfortable allowing real rates to continue climbing?
Look, Jonathan, the Fed is basically in a fog. It has kind of admitted that they've lost confidence on the short-term outlook, let alone the long-term outlook. I think a lot of that comes back to getting the inflation call wrong, and they really just want to get the job done. But they really run the risk of overdoing it, and I think they are in the process of overdoing it. And really, what's just left with is a market that's also lost confidence, especially in the bond market. We've seen some pretty big moves, and to me, it feels like a capitulation. At some point, there is a stability that comes into the bond market, but if supply keeps coming like this, I agree with Victoria.
George, a bit of a chicken and an egg question here, so forgive me, but does this bond market need equities to sell off hard before bonds stabilise, or vice versa?
I do think that an asset allocation trade would help the bond market, but it's the worst timing of the year. It's the end of the year. Portfolios are not going to get rebalanced massively in November and December. This is going to be a 2024 trade. And so really, we're in this kind of less liquid, reduced balance sheet world with a lot of bonds coming to the market, both from primary and secondary. I mean, this is where I think we're going to figure out how high we can go.
It's really hard to get a clear indication of anything right now, Victoria. You look at the data, tons of broad-based strength in retail sales this week. You listen to the companies. Bank of America says things are slowing. JP Morgan's hiking guidance. I mentioned LVMH and the airlines indicating the post-pandemic boom might be over. What can you glean? What can you take away from the earnings we've seen so far?
Well, I think we take away that we're still in that car with the clouded windshield. I don't think we have a clear picture of really where things are going. You have all of these unknowns and these uncertainties that are out there, whether it's political here in Washington, the geopolitical issues that we're facing, the economic numbers where some are good and some are bad, inflation not coming down as much as people want. I mean, there's all of these issues that I think are really kind of counterintuitive to each other. And so it leaves you in a spot, and it leaves the Fed in a spot of saying, well, how do we approach this? What do we do with our portfolios? What is going to happen in the marketplace? And I think it's where, as investors, and what we're doing with our clients is you have to take a step back and say, let's look at this from a longer-term perspective. Let's build some barbells into the portfolio on the fixed income side and capture some rates on short and long term. When you look at equities, have a little bit of cyclicality, trim some of those other names, have some staple exposure in there. I don't think you can have a clear path at this point in time to take a huge bet on the market. I think you have to kind of buffer that a little bit at this point.
I can hear people itching, George. They're itching to buy the recovery to the recession we haven't had yet. I've heard it so many times over the last few months. You're hearing the same thing?
Look, I mean, bond investors had a really tough year for the third year in a row. This actually is a worse year because you had that big rally in the beginning of the year, got people kind of trapped longs at the low rates, which kind of gave a leg to the housing market and to equities. This low rates that we had all the way up through the middle of the summer kind of then flipped with this big, massive bear steepening, which I've been discussing for months now. I mean, the bear steepening is what gets you. It's very grisly, it's very rare, but when it comes, it doesn't really leave anything in its wake. So the bear market in bonds is what we have to focus on. It's getting attractive. The risk reward is getting there, especially in mortgages. But I mean, it's too convex. Rate vol is way too high to get involved here.
It's brutal. Think about where the curve has been. Negative 110 basis points back in spring. Right now, 210s. Negative 16. The best steepening we've seen over the last couple of months. Just phenomenal. Victoria Fernandez, George Carvis, for the two of you, thank you. Coming up, the morning calls, and later, Alpine, Sarah Hunt, expecting stocks.